Hi, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and today we're going to be talking about the best annuities with low fees and high returns. So if you want a low fee or a zero fee annuity, they do have them available. Maybe you're in a variable product, and variable products are known to have high fees, some as high as 6%. So it just depends on what you're looking for. I mean, they can definitely give you higher returns with the market, but they also give you all of the market risk. So most people don't want that. They want as high of a return as they could possibly get with the least amount of fees or zero fees. So it depends on what you're looking for. Sometimes a fee is a good thing, especially when it comes to income, and the income is a standalone benefit. The fee really only affects your account balance, which if you're looking for income, it doesn't matter anyways. It's, in my opinion, I would rather part with $70,000 of fees if I get another $300,000 in income. Okay. So it depends on what you're looking for, but I'm going to show you the best options out there right now. Okay. So if you look at my screen, you will see the MYGAs, the top MYGAs that are available. These are zero fees. So I'm going to start with the zero fees first because the rates they're paying are pretty substantial. So MYGAs are the same as CDs. They're the annuities world version of a CD. And when you put in non-qualified funds, they can also grow tax deferred, whereas a CD, of course, you can't. So it's pretty nice. Of course, if it's in an IRA, it grows tax deferred anyways. But if you want something without fees and you want a high level of growth, then I would recommend these products. So, and again, you can use these for income, but it's only for a certain amount of time. It's only for the time or the term that you set it up for. So 2 years is only for 2 years. And you can see it's 5.2 is the highest. And these are the top 3 options, okay? I didn't filter anything else. I didn't filter out any ratings. If you want A rating only, we could do that too, but you don't have to. There are some decent B++ companies out there. So I'm going to go down. I'm going to say, all right, well, the 5-year, you got some decent ones, 5%, 6.15, that's pretty good. 5.6, pretty good. Okay. So 6-year, 7-year, 5.6, 5.55. 8-year, still in the 5s, 9-year, 5s, and the 10-year. Let's see if there's anything else. Yeah. Sometimes you get like a 20-year, just depends on the state. But anyways, if we look at this, Farmers Life is the highest, B++, Heartland National, B++, and then you've got Equitrust, B++. So if you want to know about these companies, I work with all of them. Equitrust is A-rated, though, by 2 different companies. So they're just actually only B++ by AM Best. So if you're thinking, hey, I want the safest B++, then you can do it. You can get 5.5. But if you're thinking, I got to have at least an A. I got to have at least an A, no matter what. Okay. Well, if you look at least an A, then you can still get the highest one is a 5.45 with Royal Neighbors. Okay. And they'll give you an interest only every year if you want to take out withdrawals every year. So some people want to do that. They want to take it out, and some people don't. But if you leave it in there, your $250,000 grows to $425,000, which is pretty good. So, and I'll show you how that compounds over time. It's pretty nice, especially when you don't have any fees. There are MYGAs with fees. These are sold by advisors who charge a fee, and they'll charge a fee every single year on this account. So when you look at the total yield to surrender, usually it's a lot less than the total yield to surrender that you would get from these annuities, because these annuities, they pay commissions. So the insurance company pays the commissions, you don't. And in my opinion, that's the better option if you're looking for a higher yield over that time. So if we look at this, it says, all right, 5.45 compound. And if you want to take out interest only every year, you can. Anything above that, they're going to charge you a surrender charge, which you can see that right here. But yeah, if you let it grow, you can see 250,000 earns 13,625. It grows to 263,625, and then that earns 5.45, gives you 14,368, and so on. You can see by the time you reach year 10, the last year you earned 21,966, because at that point you got $403,000 earning that. So it's pretty nice. And there's no fees. If you want to let it grow and then roll it over to something else, you can. You got $425,000. You can roll it over into another MYGA and continue to grow tax deferred. So that's really nice, even with non-qualified funds. So if it's an IRA, you can just roll it right back into your IRA and continue to keep it tax deferred. Otherwise, you take it out and you're going to pay taxes on the $175,000 that you earned. So that's really how that works. And all of these there's no fees. Okay, there's no fees. I guess you could say the surrender charge is a fee, but that's only if you take the money out. And you can see here the break-even age. You can wait like 2 years and you're at break-even. See? So let's see. The account value grows. Let's see, 270. Yeah. So yeah, break-even is like 257. Yeah, if you were to surrender it that early, but you can see the surrender value. You're in good positive territory after like the first year, so that's pretty good. But that's only if you surrender it. Usually, I don't recommend people set these up if they think they're going to surrender it. You want to make sure you have ample savings for emergencies and things like that outside of these contracts. So, anyways, that is the zero fee option. All right, let's look at ones that have fees. So I'm going to go in here and I'll look at the indexed options. Now, index options, you got to have the right ones because there are bad ones available. And the reason why index options get a bad rap is because you got guys that are putting people in these indexes that look cool, that are back tested, and that deliver absolutely nothing to their clients. So when I put people into index annuities, I look for carriers that are known to keep renewal rates high, which means if they're giving you the S&P index and they got a cap of 10%, I look at carriers that are known for keeping that cap there instead of dropping it to 3%. Okay, you don't want to get something that gives you a high cap the first year and then drops it way down and your returns are horrible. So I know someone right now and they're not very happy. They've been earning horrible returns and they want out. So, and it's just because the advisor put them with a wrong product. So, all right, so I'm going to go into Performance Analyzer and I'm going to do a couple things. So I'm going to first, I'm only going to look at S&P 500. I mean, you can look at NASDAQ, PIMCO, UBS. They're decent indexes, but I do like S&P 500 the most. So if we pull that in, let me show you. It's going to, yeah. And then I'm going to do, let me see here, account fees. I'll just say any because it'll show you. A lot of them are like, well, you can see account fees like 1.75. Let's see here. I want to do reset periods. I want to do annually, which means they're going to credit the interest once a year instead of every 2 years. I like more compounding periods. I like the chance to earn money more quickly versus waiting a 2-year period out. Because if you have a really good up year and a really bad down year and you get nothing because of that, you don't lose anything, but you don't get anything. That's not good either. So, there's costs to, opportunity costs. All right. So security benefit. That's pretty decent. They're going to charge you a 1% fee and they'll give you 90% participation rate. But oh, look, there's more. They give you a spread of 3%. That's just another fee. So let's say you get 90% of 10. 90% of 10, the SP earns 10% that year. Okay. You get 90%, that's 9%. Great. But then you deduct the fee. That's 8%. Oh, but then you deduct the spread. That's 5%. All right. Well, that's not very good. Okay. So I look at that. I'm like, oh, I don't want to spread. So maybe I'll look at this and say, all right, well, 70% participation rate. Well, that's not bad. 70% participation rate and account fee of 1%. That's pretty good. Okay, that's pretty good. I could definitely go for that. But NASA and Security Benefit are not known for keeping their rates there. They will lower it after that, or they could lower it, and they often do. And so when I can show you this illustration that just shows awesome returns. I'll give you an idea what that looks like. All right. Yeah, look at these awesome returns. Over 20 years, $250,000 grows to $1.4 million. That's great. But that's based off of all of the participation rate staying where it is, never changing. And the cost of options change every year. And so these companies know that, and they want to have higher profits. And so because of that, they will reduce the amount that they allow you to participate. Okay, so because I'm an expert and I work with all of the companies, I know certain ones that will keep their rates high, okay? And one of those companies is Delaware Life. So I'm going to pull up Delaware right now. They're not the only one. There's a few other companies, but this is the one I'm going to talk about right now. So Delaware Life, they've got some different variations. You got the participation rate of 55 and 60 and if you have a longer surrender charge period, they'll give you more participation rate versus the 7-year. So you got different things you can look at. The 5-year one gives you less participation. But if you're going to do long-term growth, I would stick with the 10-year. Now, Delaware Life, they've got over 70,000 of these policies in force, and about 88% of them renew at or above what you get in the beginning. And they do it year after year, which means when you get shown an illustration for one of these, it's most likely going to materialize and going to stay constant, okay? That's really important to know. So, and this one has no fee. There is one down here that has a fee. It's a 1%, and they give you a participation rate of 50%. The reason why the participation rate is lower is because they give you a 10% premium bonus. So you put up 100,000 or you put 250,000 in, you're going to get 25,000 put in there right away. And that will start earning for you as well. But there's a cost to that. The cost is they're not going to give you as much earnings on the index after that. And a lot of people don't like that. A lot of people don't know about that until after they get sold. So then you got one with just straight caps. They make it super simple and they're like, we'll give you everything, but we're going to cap it at 10.5. Okay, well, you can do that. But the thing is the S&P has done so well over the last 3 decades. It's usually better to do a participation rate. Even if the participation rate looks lower, if you get 60% of everything and the market does 30% in 1 year, that's a really good return. So I'm going to go in here and I'm going to look at that, illustrate that for you here. All right, 250,000. And again, this is showing if the S&P does nothing, obviously you're not going to lose anything. But over 20 years, it's going to grow to 1.2 million. That's not the 1.4 million that we saw in the other one, but that is more likely because you're dealing with a company that is known to keep their participation rates at a high level over a long period of time. So that is good. This is something I would be confident putting someone into. Okay. So if that helps, you want to book a call, there's a link below this video. We can chat a little bit more about what type of annuities you're looking for. Before I close the video though, I'm going to do one more thing. I always like talking about income because most people that contact me want income. So I'm going to show you real quick what the same 250 will do. Now I'm going to push this out till 70. You probably don't want to wait that long. Maybe you do. But if you're 63 and your spouse is 62 and you want to put 250,000 in and defer it out to 70, maybe you want to wait till 70 to take your Social Security, then the lifetime income is going to be roughly 30 grand, guaranteed for the rest of your life and your spouse's life, which is huge. People love that. And there is a fee. You see that? They have a fee right there, 1.1 of the benefit base. Okay, what does that look like? I'll show you. So if we look at that and say, okay, benefit base, well, look at the rider charge. That's a lot, right? Yeah, that's a ton. So, and that's only taken out for as long as there is an account balance here. It does not affect the income. The income's standalone benefit to you. Okay, they're not deducting it from this. You're not going to bill you for it. It comes out of the account value. That's why when the account value runs out, the rider charges just don't happen anymore. So if I look at this for 16 years, 16 times $4,000 is $64,000. Okay, I'm going to pay $64,000 in fees. Okay, what am I getting for that? Well, I'm getting like $777,000 in income by the time I reach 95. Let's just say I reach 96 and I get $800,000, just to make my math simple. Okay, so I'm going to pay $64,000 for that much income. What if I don't pay a fee? I don't want to pay a fee. Okay. Maybe I don't need as much lifetime income. All right, that's fine. Same exact thing. Now it's $23,588. So the difference is, what is the difference? $6,500 per year, less income. Times that by 10 years, that's around $65,000. That's your fees. So basically your fees, yeah, I mean, you save on them, I guess, for 10 years, but what happens for the next 20 years? You get all that extra income. You see what I mean? So 65,000 times like 3, that's like 200 grand. Okay. So during 3 decades. So when you're looking for 30 years, you're saying, all right, well, am I willing to pay 64,000 for another $200,000 in income? My extra is 140,000. See what I mean? So I don't like paying a fee unless I get something for it. And if it's substantial, then who cares? Okay. Now, if you're looking for something where the account balance lasts longer because you want to leave it for an inheritance, then that's one thing. Then pick the one with no fee. You can see with the one with no fee, look, I'll show you how long it lasts. It definitely lasts longer. Let's see here. It's got decent growth in the index too. Yeah, look at that. By the time you're 95, there's still like $85,000 in there. So you've taken less income. You haven't taken 800 grand. You've taken 600 grand. See, there's around $200,000 difference right there. So that's the difference is yes, you got less income, but you're leaving behind an inheritance in this account. Now, most people, when they look at this, are like, well, I don't want that. I want highest income. My kids can have my house. I can have my stock account. I agree. Most of the time when you're looking for highest income, you're not going to use this for an inheritance. And so leave your other assets for inheritance or set up a growth annuity just for growth, like the ones we were talking about earlier, the MYGA or the fixed index with Delaware, things like that. Like you can set those up for legacy for sure. And they're great. Do that and then set up an annuity for income. Okay. There's a fee for some, and then some of them don't have any fees at all. Whenever you're paying a fee, you need to have a benefit. Okay. If it's extra income, good. How much extra income am I getting for that fee? Okay. If I'm getting a higher participation rate in the index, I'm having higher growth. What is the net benefit, after the cost of that fee. Is that worth it? A lot of times it is. You just have to realize if you're paying a fee for those indexes and the market goes down that 1 year, you're not losing any money due to the market, but you're still going to have that fee deducted from your account balance. So if you're going to do the fee option for that, just keep paying the fee every year. Otherwise, you're going to say, oh, I don't want to pay the fee this year. I want to put it in something with no fee. And then all of a sudden the market goes up and you miss out. Okay. You want to have the law of averages working for you. So if you're going to choose the fee, stay with it, in my opinion, for the long term, because you're going to get the most growth out of those indexes. So, and again, for the MYGAs, you're not paying a fee unless you go with an advisor that charges you an annual fee. So anyways, those are my thoughts. If you want to book a call, there is a link below this video. It goes directly to my calendar. We'll get on a Zoom call. If you want to check out the different MYGA rates and the different income rider rates, you can do so at my website, johnstevenson.com. You cannot look at the fixed indexed rates because they are all over the place and they change all the time, and it's too complex for me to throw on the website. Okay, so if you want to talk about that specifically for index growth, not income, then book a call. We can talk about that as well. There's a link on my website, johnstevenson.com. There's a link below this video, and I'll answer all your questions. I won't try to hard sell you. I would love to sell you an annuity. If you are looking for one, I can tell you right now, you're working with the most transparent advisor out there that works with annuities, because I show you everything that's available, even if my commissions are 1% or 2%. I'd love to sell you one that makes me 5 or 6 or 7%, but that's not always the case. Okay. And that's fine. What I want you to be able to see is everything. And then once you find what you're looking for, then at that point, hopefully you feel comfortable booking a call with me. Then we can chat. You can ask me whatever question you have, and I'll help you. And if you're looking to purchase, I'll help you with that as well. So anyways, hope that helps. Please like, subscribe, share, comment below if you have any comments, and we'll see you next time.